Okay, before we begin this week, let me put out a schedule for how I'm going to be releasing videos. I did a number of live sunset feeds, and it was fun at first, but it's random. So I thought, let's stick with a schedule. Weekly, every Sunday before noon, I'll be putting the market outlook out, and every Wednesday, sometime during the day, I'll put out the Q&A from the market outlook. And it will be done as a video, not a live feed. Both of these are as video. Sunday night, I'll do a Sunday sunset video, 5:15 to 6:30 Costa Rica time, which is 7:30 to 8:30 Eastern time. And the topic will be market related. So I will just ignore any questions that don't pertain to either the market outlook or the market itself. On Mondays, every Monday I put out a video for this week in CFA stuff. And then what I'll do is a Tuesday night sunset video, 5:15 to 6:30 Costa Rica time, again 7:30 to 8:30. And I will only answer CFA related questions there. So that'll be the schedule for the market outlook and this week in CFA stuff. First Monday of each month, beginning in May, I'll put a new poem video out. I don't know if I'll do it live or not, but I'll put a new poem video out. I've done, I think, four of these so far, and the reception is pretty good, so I'll do that. Or I might do a philosophy series. I've been asked to go through Thus Spoke Zarathustra, which I think is a really interesting one to go through, but it does take more than one session to go through it and to think deeply about what he's saying there. And the last Sunday of each month is the applied level Q&A, typically on Vimeo. So I use the black screen to get that done. So that is this is the last Sunday of this month. So there is 2 sessions today. I might move it to YouTube. There isn't that much take up on Vimeo that if I moved it to YouTube, there might be more take up on that. I've been asked what the schedule is for the applied level. What I'm doing this fall, usually from September to February, is applied level content, and then from March to about July, August is CFA material I have to get up for the next season. This fall, September, starting financial modeling, the target I think is going to be Tesla, because they have a number of businesses, and what's interesting is some of them would be considered venture capital businesses, and how you would value a venture capital business inside a larger business is an interesting take. And also I'll be starting weekly reporting of any new positions in my portfolio. I'll put that up every week, and the new positions will be from whatever trade hypotheses I have to what my trade plan is. So I might say I'm going to buy 50 call options, and what my exit strategy is, or what my reduction or increase strategy is, risk management, all the way through to execution. So I'll be putting that up each week. And 7 new sub-industries coming this fall: commodity chemicals and specialty chemicals. We'll take a dive into each of these sub-industries. Gold miners and renewable electricity. I'll be doing transaction and payment processing services, education services, and casinos and gaming. So there we have it. Barely any movement in rates week over week, both money market and capital market. And you can see just a few basis points all the way through. Not a lot of excitement, as it should be. There shouldn't be a lot of excitement. So volatility is dying away there. Our curve inversions still are in place, and they're records now. The 2 to the 10 still inverted, 620 days. The 3-month to the 10-year, the more important one, has been a record for quite some time, 503 days. Canada as well. I posted on LinkedIn this week a story, I think it was from Reuters, suggesting the Bank of Canada is more likely to move ahead of the Fed, like not just at the meeting before the Fed meeting, but a full meeting before. That at the next meeting we are expecting a cut from the Bank of Canada. And probably in the June meeting, we're expecting a cut from the Fed. And we've already seen Switzerland cut, and Sweden, as I'll mention coming up, is already signaled that they're going to cut as well. Balance sheet down 27.6 billion, 14.5 of that was from the SOMA. There's only 6.89 trillion left to run off there. Only 6.89 trillion. So the net runoff was another 13 billion. Money market funds decreased by another 5.68 billion, still over 6 trillion. However, retail did increase by 4.3, both government and prime. Institution is our guilty culprit here, down 10 billion, down 12 billion on government money market, up almost 3 billion on prime. May 1st, FOMC, now 31 days away. This week we have ISM manufacturing in 1 day, ISM services in 3 days, and it is a jobs week both for Canada and the US. JOLTS in 2 days. ADP, the always wrong ADP, in 3 days, and the jobs report both for Canada and the US in 5 days. For the May meeting, the market is clearly on zero. I think that's the right number. I think if they're going to move, it's going to be June. Very little percentage on a 25 basis point cut. Let's go all the way to December 18th. 4.75, this is 3 cuts if we end at 4.75, the 4.5 to 4.75. So more than 3 cuts. Last week was a 43.3% probability. This week, 30.1% probability that we'll have more than 3 cuts. I think it's probably going to be more than 3 cuts, but the market... If once we look at Fed funds futures, we'll see the market is right where the Fed is, implied 75 basis points of cuts. I think it's more though. We got a lot of Fed speak this week. Monday is Cook. You've got 4 speaking on Tuesday. You've got another 4 speaking on Wednesday. You've got 4 more on Thursday and 3 on Friday. New York Fed, the effective federal funds rate, 5.33. That should not be surprising. The lag is now 50 basis points. Reverse repo, we expected it to be up for a number of reasons. 3 big reasons why it's up. It's at 115. Number 1, we have a long weekend. So money is certainly going to find a place to park for the long weekend. Number 2, we have a month end, and it always spikes at the end of the month. More importantly, we have quarter end. So all 3 of those things come together, increases the money that's sitting in the reverse repo. Next week, I do expect this to drop back down. That 115 will disappear, and I do expect that we'll probably be well enough below the 478. TGA down 40 billion at 772. Its target is about 750, so it's playing in and around the 750. Reserves down 17 billion to 3.47. So the reverse repo plus the reserves minus what I think is ample, 1.566 trillion, 16 and a half months. But this is skewing it, right? This $115 billion increase because of it being quarter end. By the time we get to next week, like I say, I expect this to be down below that 478. In fact, maybe even setting new lows on the reverse repo. Looking at real rates and break-even rates, also not much activity going on there at all. Sweden held at 4% on Wednesday, and a quote from them: "Inflation has eased enough to make the first of several policy cuts in coming months." So the thinking is the first cut will be May 8th or June. I think Bank of Canada moves in May. I think the Fed moves in June. If the Bank of Canada moves, the Fed moves, I think that will start a lot of other central banks moving as well. Looking at Fed funds futures, there are 75 basis points by Q4, 17 by the end of Q2, which is a maybe. That looks like 50-50. It's a maybe on a cut for June, but definitely a cut sitting in Q3 and a cut sitting in Q4. All told, 75 versus 75. I still think long December Fed funds futures is a good position. Worst case scenario, the Fed delivers exactly what it said, 3 rate cuts, in which case you don't make, you don't lose. TLT up 0.68% for the week. SPY up 0.39%. Implied volatility coming back a little in TLT, up from the zero line. There was nothing there. Let's have a look. April 19th, 93 put has only got 50 cents in at 21 days to expiration. The delta 0.278. Not a big fan of that one. May 17th, hopping over to May, which is 49 days to expiration. The 94 put, the 93 put. I like the 94 put actually. 145, 108 on the 93. Your break even on the 94 put is 92.55. And I don't think that we've been down, once you get past 94, we get down to the low 93s, and there's always a recovery. It seems to be well supported, just a slightly below 93, that I think 93 makes sense to sell puts. I think 94 makes sense if you're getting a good enough premium that puts your break even below 93. So I like that one. I like the May 17th 94 put. I also like the long December Fed Fund futures. The 30-year mortgage rate continues to give way another 8 basis points, 6.79. The spread contracted 1 basis points to 259. Housing data from last week, building permits from February, up 2.4 month over month, leading indicator of new construction. Home sales for February down 0.3 month over month, and that's consistent with house price index. This is for January, however, down 0.1. Case-Shiller down 0.1 as well month over month, but up year over year 6.3 and 6.6. The October read for Case-Shiller continues to be the all-time high on the index. Mortgage apps down 0.7% for the week ending March 22nd, and pending home sales for February up 1.6 month over month, down 7% year over year. We are going into the house buying season, which is the spring. March is now done. April, May, June are your big months. Looking at housing stocks year to date, other than DHI and Hovnanian, all the others handily beat the SPX. SPX brought in 10.79 for the quarter. Lennar 16.6, Toll Brothers 28.4, Pulte 18.8, KB Homes 14.25, and the ETFs XHB and ITB at 18 and 15% easily beat the SPX. Hovnanian 3.36 and DHI 9.79, underperformed by about 100 basis points. Corporate spreads, the OAS, following Treasury yields, very little change here. Nothing of interest to see here. Next week we should get the issuance data from SIFMA in terms of IG, high yield, and convertible. Okay, let's start with copper. Some interesting updates on copper. Here was the news of the Chinese smelters taking some capacity offline, and then of course, you know, some thinking after that, well, that's not really going to constrain the supply, and down we come. JP Morgan issuing a report, AI will drive demand for copper, but later in the decade. Quoting here, incremental demand from AI is already stressing an already large-looking annual copper supply shortfall later this decade, anticipating an additional 4 million tons by 2030, and there was already a deficit for supply versus demand by the end of the decade, adding another 4 million tons to that by the end of the decade. Data centers will need to revamp their power and cooling systems. AI servers draw more power per square foot. 3 drivers they mention for increased copper need in data centers: AI and machine learning, data centers, of course, and cryptocurrencies. Also from NVIDIA, NVIDIA will start using more copper to connect network computers less than a meter apart. And JP Morgan mentioned a couple of, 5 copper companies. They're underweight Southern Copper, they're neutral on Freeport, and they're overweight Anglo American, Teck Resources, and Sandfire. I'd never heard of Sandfire, so naturally I said, well, let me check this thing out. It's an Australian small cap company, sitting at 4 billion market cap in Australian, measured in Australian dollars, not US dollars. Trading at 8.89, they're at an all-time high. Not profitable. So I got this this chart from one of their earnings presentations to look at the change in EBITDA, 139 to 136. These are the components that made up the change. Is you have sales revenue, which took away 14, price took away 7, volume took away 10, and freight, some savings on freight, added 3, but lower price and lower volumes, half year over half year. We're not looking quarter over quarter, it's half year over half year. Operating costs added some savings in operating costs. Underlying exploration evaluation, some savings there, and corporate and admin took it away to get to 136. This big number here, 149, this is depreciation and amortization. Their volume right now isn't enough to overcome that large, relatively fixed expense on the income statement. Non-cash expense, so it's added back in the cash flow statement, but is still a charge. That if they increase their capacity, if they increase their the amount of copper that they can get out of the mines, that cost is relatively fixed, which means they can hit profitability rather quickly on this. This is their underlying earnings, negative 37 for the last reported half year of fiscal 24 versus the first half of fiscal 23. This is how it changed. Keep in mind it's 8.89. It's Australian, so in US dollars it's significantly lower, but it is at all-time highs and they're not profitable. But I think the thought here is they are small cap. Their forecast is a 50% increase in production over the coming year. And if they can get that 50% increase in production, this expense item isn't going to change significantly at all, but this will increase, which should pull this up. And I think that is the thinking. With higher copper prices, you're going to have higher EBITDA without really affecting your depreciation, amortization. Your other costs will follow in line, but this increase should result in direct increase in underlying earnings. And if they can perform at that level, being that there is a shortage coming by the end of the decade, and that it takes decades sometimes to get a copper mine in place, just to get permits, just to get the country and the people in a local area to agree to it all. 10 years, maybe 20 years to build out a copper mine. We saw in Panama that there was an existing mine that was shut down because of the negative reaction from the people in the country that didn't want that kind of environmental pollution. That acquisition is probably going to be something that the larger companies will do. So I didn't get the whole reason why Sandfire was there, but if I had to think about it, it's a nice speculative play. If they can increase their production by that 50%, they can really get a boost to their underlying earnings. That would push them to higher prices. And if they can achieve that level of operations, they might become an attractive takeover target for one of the larger companies that simply can't build out a new mine. Okay, let's spend some time here with Palantir. I have been asked this in the comments quite a bit. What do I think about this company? And I really, other than knowing that it is involved in some form of AI, I don't really know much about it. I think this run up here is what got a lot of people interested in this. This red line at the very far end is from a short report that came out valuing the company, or saying that, you know, the company is extremely overvalued, valuing it at much lower. So I thought, well, let's take a look at this company. Market cap of 53 billion, but it's sitting on 3.67 billion of cash, believe it or not. 3.67 billion of cash. So a cash adjusted basis, you're paying 49.33 for the equity on a cash adjusted basis. Assets of 4.5 billion, equity of 3.56 billion. They have no debt. Cash and marketable securities 3.67 billion, which comes to $1.71 a share in just pure cash with no debt. Revenues, here we see the valuation, the crazy valuation here. Well, we can think about it as crazy if we don't think about the future, but just look at it today. 2023 revenue was 2.225 billion. So they are trading right now at 23.8 times sales. If you adjust for cash, adjust it for cash, they're at 22.17 times sales. Gross profit 1.794 billion, operating expense 1.67 billion, operating income 120 million, which is only 5% of revenues. 2021 operating income was negative 411, 2022 it was negative 161, 2023 it's 120. Software and software services are usually very scalable, which means as you add more revenue, your costs don't scale at the same rate, so that once you hit a certain level of revenue that hits break even, as you continue to increase revenue, it primarily increases. There's a direct relationship with your operating income, and they are profitable now, but you know, nothing to talk about, but certainly a lot better than 2021, 2022. Their operating expense breaks down into sales and marketing, 745 million, which is 34% of revenue. R&D, 404 million, is 18% of revenue. And general and administrative, 524 million, which is 24% of revenue. Interest income, because they're sitting on so much cash, 3.67 billion, their interest income is more than their operating income. They actually make more from their cash sitting on their balance sheet than they do running the business that they're doing. 6% of revenue. Net income, after you add those two together, take off taxes, 209.8. EPS is 10 cents, so they are at 240 times PE, given their closing price, or 223 on a cash adjusted basis. Shares outstanding at 2.147 billion, on a diluted basis 2.298 billion, which is a big difference in the share count here. If we look at their cash flow statement, stock-based compensation 476 million. I didn't do a deep dive on their 10K. This would lead me to head to the part of the 10K which has stock compensation, and look at how much is potentially lying ahead in terms of dilution. They are cash flow positive. Cash flow from operations, well, I shouldn't say cash flow positive. From operations, they're cash flow positive. 2023 was 712 million. Let's look at some forward metrics. Look at their sales growth. And they do provide guidance for 2024, so I put in their 20% guidance here. 2021 to 2022 to 2023 to 2024, we have 3 actuals and an expected. Growth rate here 23.6, next year's growth rate 16.73, and they're forecasting 20% growth. That's not out of line with the last 2 years, it's kind of in there. I would question the 16.73, why it wasn't bigger than the previous growth the year before. AI is the latest thing, it's all the rage. If this is what you're selling, if you're selling solutions for this, why the lower growth rate? Right here, I'd have a question mark of why didn't this come in at 30%? It would be more of a story at 30%, but 16.73. So price to sales on a forward metric, if we take their 2024 earnings, 19.85, adjusting for cash, 18.47, that's looking at the current price. and looking at a forward multiple. EPS estimate 39 cents. So it has a forward PE of 61.17 or 56.7 times on a cash adjusted basis. Just to give us some idea of valuation, if we're looking for a forward peg of 1, given a growth rate of 20%, we would multiply earnings by 20 times, and that would give us a peg ratio of 1. The stock would be $7.80. At $7.80, it is potentially growth at a reasonable price, if they can, in fact, deliver that 20%. Peg ratio of 2 would put them at $15.60. A peg ratio of 3 would put them at $22.40. And if we look at their cash adjusted price, it's $22.15. They're pretty much at their cash adjusted price. So on a forward basis, they're trading at a forward peg of 3. 60 times earnings at 20% growth. Yeah, that would be overvalued. Now, I looked for guidance in terms of earnings. All I could find is a consensus of 39 cents. That's all I could find. So I looked for guidance on their costs, and the only guidance I said is all of these will increase on an absolute basis. They'll all increase on an absolute basis, but not on a relative basis. Meaning they said nothing about that. So they'll increase on an absolute basis. Does that mean that they will come in at 34, 18, and 24% of sales? Or will there be some scalability here such that your costs aren't going to scale up at the same rate as your revenues do? So if we think 20% growth in revenues, but only 10% growth in these, then you can expect to go from 10 cents a share to 39 cents a share, as opposed to just 14.8 cents per share. If everything grew proportionately, you'd be at 14.8. I'm not going to show the math. I mean, I've done the math already. You just take my word for it. It gets to 14.8. My thinking is if there was scalability in there and you're giving guidance, you certainly would have said something about it. But there does appear to be some scalability in here. You're growing revenues at 23.6%. You went from a loss of 411 to 161. That's a $250 million gain between these 2 years. You grew at 16.73. You went from 161 to 280. That's a gain of 280 million. So you gained 250 at a 23% growth. At a slower growth, you gained 280 on your operating income. You got 20%. Is it unreasonable to think that you could add 300 to the bottom line, to OPEX on an after-tax basis? Yeah, you can probably get close to 39 cents. I get around 33 cents, but okay, we'll go with 39. So at 39, these are your metrics. A forward multiple, not cash adjusted, of 61. If you adjust for cash, it's 57. Some people don't like to adjust for cash because they say, well, hang on a second, management controls that cash. They could just blow it. They could invest in stupid things. Since the cash is not in my pocket, the cash is risky cash. It's not risk-free, it's risky cash. I have to use the 61. But the cash is generating nice interest income, 136 million. If interest rates are going down, because this is going to be in marketable securities, this will start to drop as well. So imagine over the next 2 years that interest rates drop and this gets cut in half. You'd have to at least increase your top line just to recover from that. So as far as a short goes, I'm not too convinced that I would short it. I think, it's probably overvalued, but it's a hype stock, and that means it's going to have a behavior that is uncoupled from its earnings, and we've seen that can stay around for quite some time. So shorting this, I don't like that idea. And I think on the report I read, the target was $20. On a cash adjusted basis, you're $22.15. I think the report came out though when it was well over $25, down to 20. and it took a big hit on that report right away. If I adjust for cash at 22.15 and there's a target of 20 on the stock, that doesn't really excite me very much. And it's in the AI space. You get a quarter where they're able to scale. In other words, their costs go up 3%, but the revenues go up 9%. That's going to trickle right through to EPS very quickly. You can get rapid growth in EPS and up you go. I would not touch this as a short candidate. I also wouldn't buy it until I can see that they can actually deliver each time. They have, I mean, from 2021 to 2022 to 2023, they have been delivering. My hesitation is this number here, 16.73. Last 2023 was the year of AI. It was the year of AI that I think that you could have built out a little bit more than that in terms of revenues. But then again, 2023, maybe when I'm thinking the year of AI, maybe that is the infrastructure build out is really the big thing, but the application isn't there yet, which is usually follows after the infrastructure is done. And if that's the case, then I certainly don't want to short this thing. But there's my take on Palantir. I'm neutral on it in the sense that I wouldn't buy it at these valuations, but on any significant correction, it looks like it's got something going here. And I wouldn't buy it, and I wouldn't short it, even though, if we look at it, we do sort of have a head and shoulders here that if you take the top to the bottom, what is this, 23 minus 5, 18 would be the target down if we want to think technically on that. Well, I'm just going to leave it there. Let's just be clear, I did not do a deep dive on this one. I really just looked at high-level financials for valuation metrics. I didn't read about its two platforms. It has commercial and government. I didn't read in on any of those, which one is the fastest growing one. It also has an AI overlay for those. I didn't go into detail about what this company may potentially have that others don't. What makes it a company to invest in, that it can do that other companies either are not doing or cannot do. I have no idea. Okay, an interesting arb trade presented by Carisdale Capital, and I read it and I thought, I'm so jealous I didn't think about it. It is so beautiful. And it's a really simple arb trade. Buy Bitcoin, sell MicroStrategy. MicroStrategy is the bottom chart. See the big red bar right there? That is the short report, the effect of the short report. Down 11.3% on Thursday, down to $1,702 a share. That's a $217 move in one day. Their argument is elegant and simple. MicroStrategy is sitting on 214,246 Bitcoin. That represents 1.09% of all the Bitcoin. And if you take their market cap, 38 billion, you adjust it for the value of the software business, they're giving a valuation of the software business of 1.3 billion. You get to 36.7 billion. That means that each Bitcoin on MicroStrategy's balance sheet is worth $177,000, but Bitcoin is trading for under 72. If you value the 214,000 Bitcoin at market prices on Thursday, it comes to 15.34 billion. Now, typically when we see a company with a balance sheet of all financial assets, the value, the market cap of that company will be the value, will basically very close to its book value or its tangible book value per share. There is no reason why you would pay a premium for a company owning Bitcoin when you can own the Bitcoin itself. And the argument was with ETFs. What do you need MicroStrategy for? MicroStrategy used to be a way to get Bitcoin exposure without having to buy Bitcoin. Well, you can buy ETFs now, and ETFs trade for NAV. So the argument is, shouldn't this be valued at NAV? Shouldn't the Bitcoin be valued at what the Bitcoin is? Because it's 15.34. If you say no, then what you're implicitly saying is their software business is a $23 billion business, and they're valuing it at 1.3. That would be quite the stretch. Even if you value the software business at $5 billion, you're still at $33 billion versus 15.34. It seems to make a lot of sense to me. So how are we going to get this done? A number of ways to do it. You can go long GBTC and short MicroStrategy, and you would do it with equal dollars because it is an arb trade with the same underlying Bitcoin. If we are going to short MicroStrategy, we want to know what the borrow rates are. It's not bad, 0.48%. IB has about 28,000 shares available to short, which isn't very much. So if they can't arrange a borrow, you got to be concerned about short squeezes in here, and you may have to cover your short position before you want to. But the fee rate isn't that bad, 0.48. But because it's such a nice setup, I think, well, I want to use leverage. How do I get some leverage involved? The 2,200 calls are $359. This is for July. 359, so it's 35,900, and the $2,500 calls are 298 or 29,800 by selling the 25s. The highest level they've ever reached was just below 2,000, and now that this information is out here where people can look at it and say, yeah, hang on a second, with the ETFs, what the hell do I need? What do I need to pay a premium to MicroStrategy for to hold Bitcoin when I can hold it through an ETF? So the Bitcoin should be valued at its asset value. That means that's one thing. Now you can value the software business and just add on the value of Bitcoin. And there's no sense in paying a premium saying, well, yeah, but Bitcoin could go to 100,000. Well, then own a Bitcoin ETF. Why pay the premium for it and wait for the price to get to that point when you could just buy a Bitcoin ETF and ride that price up, right? It makes perfect sense to me. So I like the $2,500 calls at 298. I like that. Another strategy here is to buy the Bitcoin ETF, buy $148,000 of the Bitcoin ETF and sell a $1,000 call, sell an in-the-money call. That's $835. I get two premiums in there. I get the ARB premium from the 177,000 down to the 72,000 where Bitcoin is. And being that Bitcoin is trading at 1702 and this has got 835, it's got another $133 of premium in there. I get a delta of 0.87. So 100 times 1702 times 0.87 is 148,000 because I have to take the current price and I've got a delta of 0.87. In other words, I got delta of 87, so it's basically 87% of the price, and the contract's for 100. If I sell a $1,000 call for July at 835, I would then buy Bitcoin 148,000 of GBTC as an arb trade on that one and bring leverage to it. I like this one. For smaller accounts, you can go with just the Bitcoin ETF and shorting MicroStrategy, but keep in mind you are paying to borrow the shares and you are subject to short covering if it comes in. Also selling calls makes sense for July. The 2500s, if the highest level was $2,000, and you are long, let's say the ETF, and you sell the call, I don't know that you could, let's back that up. This is just selling a $2,500 call at 298. If you were also long, that's a better way to say it, then I don't know that you could lose on that one. I like the 2500, and I like this setup. When I read this, I got really jealous. I thought, my God, it's so obvious. Why didn't I think of that? But I thought you might like to see that. Look at the implied volatility on this thing, 142.7%. That's crazy. Very high implied volatility, very high premiums. Okay, let's look at the yen. quite some interesting things that happened there. It touched 151.97 on Tuesday. That is a 34-year low on the yen. There was a meeting between the Bank of Japan, the Finance Ministry, and the Financial Services Agency scheduled for Thursday. They brought it up to Wednesday, an emergency meeting up to Wednesday. Some quotes: "Now we are watching market moves with a sense of urgency. If there's excessive moves, we will take decisive steps and not rule out any options." They were talking about the value of the currency. Stepped in. They stepped in at this level. Last time was here was October of 23 when they stepped in, and it is at those levels again, and the rhetoric has begun to increase. A Bank of Japan board member is advocating moving slowly but steadily towards policy normalization. That should strengthen the yen, and with the three of these guys holding an emergency meeting, talking about, we're very concerned. We're gonna, we are watching with a sense of urgency. I don't know that I would short the yen at this point, in terms of using it as a carry trade. They have stepped in here before. I've said this in the past, that we're approaching the level where they have been known to step in, and the rhetoric. Usually you start this way, right, with talk, and you see if talk will back off the market, but talk will only do it for so long. At some point they will have to step in. I'd be more likely to buy the yen as a speculative play at this point, just on intervention, than I would use it as a carry trade. AT&T, 1760 close. It's really moving up, making the 17 puts, not very profitable to sell. Looking at the May 17 put, currently, this 48 days to expiration is currently 38 cents. It's not bad, but on Saturday, this headline came out. Personal data leaked and is on the dark web from AT&T. 7.6 million of their current customers and 65.4 million of their former customers. That's a lot. Social insurance numbers and things like that are out there. So AT&T is offering credit monitoring at their expense where applicable. Well, that's going to be a cost. That is going to be a cost. So I'm looking to sell the May 17th on Monday weakness, if there's any weakness, being that this happened on Saturday and they're suggesting that they will pay for credit monitoring. You've got some 72, 73 million people. That's it says where applicable, but it's going to be applicable in a lot of cases. You're going to have a one-time charge on your earnings. If there is any weakness on AT&T back down to the $17 mark, I will sell the 48-day puts. Hopefully the volatility will spike and I'll get maybe double the 38 cents, maybe looking for 75 to 80 cents. That would be nice, but I will be watching that on Monday. Any move down the 17 on that, because this is an event, right? This is an event. It is not a trend, and you trade events, you invest in trends. There are good trends with AT&T in terms of debt reduction, in terms of the way they're rolling out fiber now in partnership with an infrastructure fund. Those are trends. Those are investable trends. This is an event. So anything that causes that price to drop on an event is a tradable situation, and I will be looking at the May 17s. So on this screen, I would be, I don't know if I will, but I would lean towards a speculative long position in the yen because of what Tamura is saying, policy normalization, and because of the potential for currency intervention. And AT&T, on any weakness, I would heavily sell the $17 puts. Okay, Russell 2000, forward PE 26.3, forward earnings 80.25. I wanted to check about concentration because S&P has concentration. It's hard to think of this of the Russell as having concentration, but SMIC, super microcomputer, and MicroStrategy make up 3% of the index, and we know MicroStrategy probably is heading down from their $1,700 price because that arb trade just makes perfect sense. Why everybody wouldn't take advantage of that is beyond me. and SMIC. Well, just have a look at the chart, right? So the 26.3 forward PE, some of that is the result of these two companies. They make up 3% of the index. Not a lot, but some of that forward earnings comes from there, or some of the performance. No, I shouldn't say some of the forward earnings. Some of the forward multiple comes from the price increase in those without the corresponding earnings coming along. 80-25 year to date. Russell 2000 is up 5.4% in the last year, up 20%. Their all-time high is 241.81. That was November 5th, 2021 at 241. They're sitting at 210 right now. Like the S&P, very low implied volatility. Torsten Slok, Apollo chief economist, points out 40% of companies in the Russell 2000 have negative earnings. But you do have growth in earnings forecasted. Q1, this is year over year, will be down 11.4%, but Q2 will earnings year over year for Q2 will be up 20.4, Q3 39.4, and Q4 54.3. At least that is the consensus of analysts, is you'll have that kind of growth based on the estimate of forward earnings. It represents those growth rates. But these growth rates are already in the forward earnings of 80-25. So given those growth rates, it's already in the 26.3. It's not as if, well, it's 26.3 because we're going to get those. It's already in there because it's the 80-25 represents earnings that represent those growth rates year over year. I think a little too expensive. At 26.3 times forward earnings when 40% of these companies have negative earnings. Now you could make the argument, well, interest rates are coming down, so debt levels on these companies, or the interest rate on the debt will start to drop. To the extent that they have floating rate debt on their balance sheets, maybe that would be enough for them to turn profitable. But given the fantastic growth rates that we've had in GDP for the last little while, if it hasn't translated into stronger earnings and 40% are still unprofitable, I don't know what lower growth is going to do for this index. I would not be buying at 26.3 on this one. I don't even know that there's an interesting options play that I like on this one. SPY, another all-time high, 522.95, putting it more into the unaffordable category. Unaffordable in the sense that it's just too expensive. 21.75 times forward earnings, and it went up from 21.65, all just from the multiple expansion. Because if we look at earnings, SPGlobal basically the same week over week, LSEG slightly down week over week, which means any increase in the multiple is purely just multiple expansion. It's purely the market saying we want to pay more for the same thing, and they are. Adjusted for 6.3% earnings surprise, if we assume that earnings can pull that out all year long, you're still over 20 times forward earnings, 20.48. This is interesting. Societe Generale, I didn't read their methodology, so I'm just going to report their findings here. The SPX would be 700 points lower without the AI boom. And if you exclude the NASDAQ, any of the NASDAQ 100 companies from the S&P 500, S&P earnings have actually fallen for the last 2 years. Not increased, but fallen for the last 2 years. Russell 2000 at 26 times forward earnings, I wouldn't be a buyer. S&P, we should expect a lower multiple on there because growth is harder to come by at larger size, but 21.75, considering a long-term average of somewhere between 16.6 and 17. We're at 21.75. Moving back towards multiples we had in the excesses of the pandemic spending and zero interest rates. We're moving back to that. The S&P is sort of telling us that interest rates are going to zero with these multiples. And if it were in the near term, then I would say this is probably where you want to be with free money. But money's not free. Money's not free right now, and it's going to be a while before money's free. I believe the end game is money will be free. I believe that's the end game. Because you got to pay for all this debt. Well, you can't pay for all this debt and pay 5% interest on it at the same time. Something has to give. And with democracy the way it is, it's not going to be debt levels that have to give. It's going to have to be the interest costs that have to give. I believe zero is the end game here, but not for some time. And so these multiples are uninvestable, but there are lots of good targets to look at. I still like copper. I still think selling puts on GM makes sense. GM is hitting 52-week highs every single week. I like AT&T. I like selling puts on that one. I've laid out a number of trades this week that I like. I just don't like anything at the level of the whole. I don't like the market at this multiple, either small cap or large cap. So I will continue to dig under the surface, and I think it is we have the only thing to invest in is the market of stocks, but not the stock market. NVIDIA, usually I'm saying, well, it eked out again here. First time in quite some time. Well, week over week we have a loss on it, $40, failed. Tried a couple of times last week to breach 950, heading to 974 to set new all-time highs, and it didn't. It couldn't get past that. So let's see what happens next week. We have jobs report next week. That's the big tone for the market next week is jobs and a lot of Fed speak. I don't know that Fed speak is going to do too much more now. You got 75 basis points in the Fed funds futures. SEP has 75 basis points. I really don't know that there's a lot to say on that respect. But keep in mind, you do have, I think, what do we got? 17 speakers next week. 3 big jobs report, JOLTS, ADP, and finally the jobs report on Friday on both sides of the border. Well, that's all I got for this week. I will see you for the live feed for the sunset.